So welcome everybody to the bonus webinar. This is the first of three that we're doing only for folks who have ordered the Trader's Handbook. So first of all, I want to thank you guys for helping support us. Really excited to get it in your guys' hands and hear your direct feedback. But I know you guys will really enjoy it. And, I think these webinars are an amazing complement to it. And again, our goal is to make the best introduction educational resource for trading. And that's exactly what we're doing with the handbook, with the educational resource, with the model books that will be a part of it, and also these webinars, both the kind of standard webinars that we're doing and these bonus ones, which get a little bit deeper into some of the key setups that we trade. So hopefully you guys are really excited for this, as well as getting your copy of the Trader's Handbook. So today, as we've talked about, the focus is advanced breakout strategies. We'll go a little bit deeper into trading-based breakouts, early entries as well. That's kind of the focus for me. I'll talk about why I prefer early entries versus trading the standard-based breakout later on. But in short, it's just a tighter risk managed entry, and it also allows us to position before a stock is really in the eyes of the market. And we all know that there's a lot of volatility. Everybody knows what base breakouts are now. So we have to adapt and be a little bit more creative and enter at earlier buy points. And we'll get into that in just a minute. I wanted to start with a quote from Nicholas Darvas, because truly this is a setup that, every market wizard has traded, going back to Wyckoff, Jesse Livermore with his pivotal points, and then of course Nicholas Darvas, and we'll talk about Stan Weinstein, William O'Neill in just a second. But there's a great quote from his book when he kind of was developing his box trading strategy, which is really a base breakout trading strategy. I started to realize that stock movements were not completely haphazard. Stocks did not fly like balloons in any direction. As if attracted by a magnet, they had a defined upward or downward trend, which, once established, tended to continue. Within this trend, stocks moved in a series of frames, or what I began to call boxes. They would oscillate fairly consistently between a low and a high point. The area which enclosed this up and down movement represented the box or frame. These boxes began to exist very clearly for me. And if you've read his book or studied Darvas at all, you know that his style was to buy when a stock set up a range just like this, a base as we'll call it, and broke through the top, the ceiling of that base. And that was his strategy. He would trade high momentum names and trade those base breakouts. Nothing different than the top market wizards are doing today. The top traders in the USIC, the top momentum traders right now. It's the same exact strategy. Just of course we have to adapt it to the times. There's different forces in play now compared to when Darvas was trading. But the same overarching setup and principle it still applies. And I just want to pause really quick to add, if you have any questions throughout, please let them be known in the Q&A section down below. Don't put them in the general chat, because I'm a one-man show, and it would just help me immensely if you keep things organized. So if you see anybody asking a question, gently remind them again to place it in the Q&A section. And also just a reminder, if anybody asks about this is being recorded, it is, and you'll have this for life. And if anybody asks later on, let them know as well, gently and kindly. Perfect. Let's go ahead and keep going. So here's the agenda today. We'll talk a little bit from a high level what the base breakout setup is, when it works best, big bases and why they work. And then we'll dive deeper into identifying pivot points, the actual buy point for trading early entries. Then we'll discuss the process for screening for breakouts. I might give a demo in DFU as well, kind of how I do it. Then we'll discuss building focus lists, because I think a big question that a lot of folks have is, how do you narrow down to the best opportunities? What are the things you're looking for, both from a fundamental and technical characteristics in terms of picking stocks that actually go on your focus list? Because there's a lot of setups and we want to narrow it down to the best. So we'll talk about that for sure. They'll discuss breakout entry tactics, trading a range. You probably heard me present that before, but we'll dive a little bit deeper today, and also talk about what happens if it gaps above the pivot, which is a common occurrence, and I think people need to know how to deal with it. And then we'll discuss just some key reminders, and then go through a few more of the model book examples that will be part of the base breakouts model book. So really excited for this. Let's go ahead and dive right in, and let's go. So here are the key goals of the webinar. First, we're going to discuss the base breakout trading setup and early entries and why I prefer them. Then we'll discuss a trading basis playbook, kind of a checklist of sorts to, as you're analyzing a chart and looking for a base breakout, what to actually look for. and we'll give kind of a framework around that. And then we're going to develop a process for identifying early entries and pivot points. I'll talk through how I identify ranges and some tools that can help you with that. And then, of course, we're going to study some key examples of historic and recent base breakouts to really, bring the concepts that we'll talk about to life, because we want to be able to apply this in real time tomorrow or this weekend. So we don't want to just keep it to the high level stuff. We want to really get into the details, and that's exactly what we'll do. All right. So first, as I mentioned, this is really a setup that's been traded throughout the ages by all of the top traders. Going back to Wyckoff, going to William O'Neill, Darvas, Stan Weinstein with a stage 2 continuation. This is a breakout setup right here, looking for the same thing O'Neill's looking for. To current days, everybody's trading base breakouts, ranges after EPs, that type of thing. Mark Minervini's VCP. It's all the same conceptual setup where you're looking for a super strong trend or an explosive move higher, and then a pause as supply is absorbed that comes to market, and then there's subtle accumulation that buys up that supply, and then a reconfirmation and restart of that trend. So the general pattern that we're looking for is a trend or powerful move up, a tightening in price below a defined level, and then a breakout through that level or early resistance level before that resumes that trend. And we want to capture this trend so we can ride it and participate in that strong trend. So the key point here is that this is a setup that has worked throughout history. It's an element of supply and demand. It's not a pattern to memorize. It just happens naturally as institutions accumulate supply, and that's basically the great thing is this will work. This works now, and this is going to work 10 years down the line. We might have to adapt our strategies a little bit, our entry tactics, but the overarching setup will still be valid. And then this is just a slide of app. This is a recent, really good example from last fall that pretty much encapsulates what we want to capture with a base breakout. We see a nice base right here. We see a strong move up here, and then a tightening in price and volatility, decline in volume right here, a clear early pivot point through these highs. You've got the overall base pivot right here, and then we see a breakout on a pickup in volume and expansion upwards, and this went and doubled or more from this buy point. This is exactly what we want to capture, and we'll talk through frameworks and processes to identify these early and actually trade them. And this isn't a hide and sight type chart. This is featured in real time to folks in the Trade Lab, so I hope many of you caught that. But we're not talking about something that only works in hindsight here. We're talking about real world trading and using examples that are current or are actually realistic in terms of what you can actually capture. So here's a little bit about the overall base breakout setup. This is a continuation setup. The base breakout is a continuation setup that follows a prior uptrend or powerful move higher and forms after a multi-week consolidation, typically at least 5 weeks. Depending on the strength of the stock, you can shorten that time frame a little bit. So everything's a little bit in context as is all trading, but basically you're looking for that general time frame of at least 5 weeks to make sure it's mature enough. And we want to distinguish it from trend starting setups like the launch pad, which occur kind of earlier in a trend, really at the start of a stage 2 uptrend. What we're looking for in a base is tight price and volume action. We'll dive deeper into this. The healthiest bases exhibit tightening price and volume action from left to right, which reflects decreasing volatility and increased accumulation. And again, I think a lot of people know based on other concepts that we're looking for tightening in price from left to right in a base, but actually we're also looking for tightening volume at the same time. That really shows that there's supply coming to market that's being absorbed, and then at the end of the base, when everything's tight and ready to explode, that volume really dries up, and that lets you know that a stock is ready to actually expand higher and continue that longer term trend. Early entry advantage. Given the frequency of breakout failures in recent markets, traders are advised to look for slightly earlier entries as the stock approaches the breakout zone rather than waiting for the actual breakout. And I think this is a key concept that I really want to focus on today. Why are we looking for these early entries that maybe don't have quite the same batting average success rate, but they're preferred because simply you can manage risk tighter, and it's pretty much that. It's a tight and logical entry. It gives you a tighter entry. You can build your position higher. And what that gives you, if you enter early, is if that is successful, that pivot breakout that maybe is a cheat or even a low cheat, as it approaches the base pivot, it's often expended a lot of energy. And at that point, everybody's watching the stock. Everybody sees PLTR approaching highs recently. So entering at that point when everybody is seeing that stock, has it on their screen, is looking to enter, basically it is a negative because there's often volatility at the pivot level because swing traders are selling into that strength. Even institutions are selling some into that strength, into that key base pivot level, and looking to buy back later on as it pulls back afterwards. So we want to use that early entry advantage to manage risk tighter and get in and have a nice cushion so we can stomach that volatility that often occurs, that pullback that often occurs after a stock is approaching all-time highs. Breakout confirmation. On a successful breakout, a clean move through resistance occurs with a surge in volume, which signals, again, institutional involvement. We want to see big signs of volume coming in. And this is kind of what I was talking about as well. This is why we want to have an early entry advantage, because in recent years, we've often seen breakout failures that then reset, pull back to the 21 EMA, and then reconfirm. This is something that Ross has really seen as a change in the market, is clean base breakouts, work in the best markets, but more and more often you're seeing, a failed base breakout that shakes everybody out, looks to break down, that then resets, tightens up at the 21 EMA or another key support level, and then breaks out and sets up another entry. So really we're looking for either an early entry or an entry after this failback and reset. And actually, if we go back to app, look at this. So it's so powerful off lows, it's expended all this energy, and then into the base pivot level, you can see it stagnates. There's some downside reversals. There's wicks here. It tries to break out, fails down. And then what does it do? It pulls back into the 21 EMA, finds support at the 50 SMA again, tightens up these 2 days, sets up a pivot through these highs, and then breaks out. And this is when it actually goes. So if you're entering here, sure, you can try it and just be stopped out for a small loss the next day. But it's almost better to be waiting for that 21 EMA reset and new pivot, new range to form, and tightness to basically capture this move, the real move, because you kind of recognize that it's expended so much power off lows already. So that's kind of what we're getting at here with this last bullet point. All right. Then just taking a step back for an instance, we're not trying to trade every single breakout that occurs. We're always trying to capture the true market leaders, the highest momentum names, and stocks that meet the Tigers framework, because we want stocks that double and triple, and stocks that double and triple meet the Tigers framework. So again, we're looking for theme, innovation, strong growth, edges, relative strength, setup, basically the can slim characteristics adapted a little bit more towards modern markets where revenue is preferred and momentum is kind of the way to go. All right. So this is a concept that I want to start with because it's important to always remember that the base you're looking at is always should always be set into the context of where we are in the move and what the overall chart looks like. Because big moves, multi-year moves occur coming from multi-year consolidations or several month-long consolidations. This is Tesla back in the 2018-2019 timeframe. It actually had been going sideways for years. But then we had its first profitable quarter here, and that really started this multi-year move that made many people millionaires and went up several thousand%. But this move and these base breakouts that worked are all coming from this nice large base here. So we're always looking for a large consolidation, a large pullback that kind of resets everything, that resets the institutions so that they can start accumulating again. And that's what leads to successful base breakouts early in the trend coming from a large consolidation. This can be a stage one in terms of stage analysis or after a significant bear market decline. Here's another example with Nvidia. Again, we had that large 2022 correction, and that set in store the significant move that we've had so far, over 1,000% move. And these base breakouts all worked along the way, but that's because we're coming from a larger consolidation and pullback. So we're always looking for a stock that has a large consolidation, has a neglect phase, and then often there's a catalyst, a new product, a new development like AI becoming mainstream that drives the growth in these stocks. Here was EV adoption and Tesla finally becoming profitable. And then this, of course, was the surge in AI, ChatGPT, that led to this dramatic move. And then one more example, this is PLTR. We had a large base after a significant decline. You can see it was bottoming for, almost a year here. And then again, I think there are hints of profitability here, invigoration of AI platforms. And again, PLTR up 1,000%, several bases and base breakouts along the way. But all of this is driven from a significant bear market, significant decline that then bottoms out and starts a new uptrend. So again, when you're thinking about trading a base, always think about where it is within its overall time frame, the overall stage 2 uptrend. And we like to focus on earlier ones in the trend. This one, of course, we did have a correction again, which kind of resets things in the market. But this is later in the trend compared to these ones back in this area. This one, you caught some really nice move. We had an earnings gap here as well. But one reason why this could be considered a little bit more early in the trend is because we just actually broke through all-time highs. So again, think about in context, where we are in that trend. And avoid late stage bases and think about and focus on stocks that are earlier in their stage 2 uptrends. All right. So I wanted to kind of include this slide here to think about the different bases that we like to trade. There's kind of 3 different type of bases to focus on. First is the IPO base. We've got an example with Google, and I'll zoom in just a second. This occurs shortly after an IPO. It can set up a really fast, nice move in the IPO boom phase, but often this phase is short-lived, and there might be an amazing trade early on off the bottom of that IPO base, but likely the stock is going to roll over and start a longer-term basing period and set up its first kind of primary base, which can set up a whole new opportunity. Here in the middle, we've got the bottoming base. This is a more gradual base that often is longer in duration, and basically the stock continues to form out here. It doesn't make any progress lower, but it doesn't really make any progress higher, and often you need a catalyst like earnings or a change in the market to set off a new catalyst. This is actually PLTR at its bottom, and this is the earnings gap that really started that 1,000% move. Then when we're actually in a move, we've got continuation bases, which are within the longer term trend. There are pauses as supply is absorbed again and institutions continue to accumulate. And this is kind of my focus along with the IPO bases. The bottoming bases can work, and definitely I like to trade them if there's an earnings gap and significant catalyst. But my bread and butter is more trading the faster moves from the IPO bases and continuation bases, and simply because there's a little bit more head fakes here with these bottoming bases. They can look like they're breaking out, then fail and reset, and have to go through a whole new consolidation period. So I typically like to focus on IPO bases and continuation bases. There's less overhead supply to deal with here, and the moves can be faster and a little bit more explosive, while these can be a little bit longer duration and can set up some amazing moves too. But just in general, I like to trade these two. And let me know in the chat if you have a preference between these 3 different types of bases. All right. And I'll pause for questions and just a few slides here to catch up here. All right. So let's talk about how we actually trade bases. And Oliver Kell, many of you guys know him. He's had a tremendous impact on how I trade, how I analyze the markets, and his price cycle, his cycle of price action is a framework to analyze bases and uptrends to downtrend transitions, which really is what a base is. A base is basically we're in a longer term uptrend and we start a short term downtrend and then reconfirm higher and begin that uptrend once again. So again, we're in a longer term uptrend. We pause on a daily chart and begin a downtrend, break below the short term moving averages, firm up again, and then restart the uptrend. And if we're in a longer term uptrend, this often carries on, and then we'll maybe form another base as we continue higher here. But this framework, the Oliver Kell price cycle, is an amazing way to internalize and get a framework, a blueprint to analyze and interpret price action. So you can kind of get a general idea of what to expect next. And we have a really good free course on teaching this on the TraderLion website. I'll probably email that out to you guys later on. But really what I want to focus here today is the downtrend to uptrend transition. And we'll talk about our trading a base playbook. And it's really based on what Oliver's talking about here. So a wedge drop is when we start breaking below the moving averages. We're starting a new base. We form lower highs back into moving averages and form an EMA crossback that reconfirms down, and then we get extended to the downside. And we'll show a bunch of examples of just this. So if this is a little bit too conceptual, keep that in mind. We'll get to it. So basically, we look for an extension to the downside, and then a retest of the moving averages from below, and then a tightening in price and volatility, and then a pop through the moving average, and this starts the uptrend, this wedge pop, what he calls this pop through the moving averages, and then we start finding support at the moving averages and forming higher highs and higher lows, and that starts the uptrend. So again, remember the break below the moving averages, the extension to the downside, the pop higher, pop through the moving average, and then we start a new uptrend forming higher highs and higher lows. So again, let's get into our trading a base playbook. So basically, like I said, we're looking for an extension down, or on the flip side, we could have a gradual bottoming tightness type action at the bottom of lows. That's kind of the two different ways that bases bottom, is either we get a sharp volatility down, extension down, and sharp bounce up, and then we form higher highs and higher lows, or it's kind of a little bit more gradual, and we, instead of having the sharp move down, we just kind of gradually refuse to move lower, and we just get tighter, we oscillate up and forth, and then we start to move higher. So those are kind of the two general ways a stock can bottom within a base. Then after that bottom occurs, we're looking for signs of power off the lows, gaps up, reclaims of moving averages, powerful moves, 20% moves off lows. And then what we're looking for after that is the formation of the first higher low. This is the first sign that we should really say, hey, let's go ahead and pay attention to the stock, especially if it meets the Tigers framework, has a catalyst, is showing relative strength versus the market. We're looking for that first higher low. Then as the base matures, we're looking for entries at tight areas, moving average reclaims, constructive pullbacks, or any other entry tactics as the stock is generally moving up the right-hand side of the base. So again, these are all entries up the right-hand side of the base. It could be the pop through the moving averages. It could be the pullback into the moving averages. It could be, a handle or low cheat, which are basically the basin breaks. But basically, we're looking for tight areas up the right-hand side, or other ways that we can enter the stock while managing risk under about 4%. So again, we're looking for very tight entries. Then we look to have a full position before the standard base breakout, because once we're in this area up near the prior pivot, the stock is in the focus of the market. There's often volatility up here. Institutions who bought down here, or traders who bought the bottom here, are selling into strength, selling into that level as the stock gets extended into it. And often there's a pullback or another consolidation before the stock ultimately moves higher, if it does so. And then after you're in the stock, it's very simple: manage the position versus uptrending moving averages. I like the 21 EMA, and we did a whole webinar on sell rules, but I'm looking for 2 closes below the 21 EMA once I have a cushion, and that's pretty much how I handle things. So this is kind of our higher level framework for trading a base. And let's go ahead and show an example. Here's app again. We get the wedge drop, break below the moving averages. We get lower highs, lower high, reconfirmation down, extension down here. We see a gap, strong move lower. It gets bought up. This is the bounce off the extension. And then what do we have here? We have the first higher low that forms with a strong move higher into the moving averages. Often there's a pause in the moving averages, and then we'll set up another higher low. This one just kind of reconfirms higher, breaks above the moving average. This and this would probably be the earliest buy points. But even if you miss those, it's no worries, because you can wait for a range up the right-hand side. We see a nice expansion up. This is a range that forms, but there's no real follow through, and it's pretty close to the base pivot after a powerful move higher. And after these powerful moves higher, often the stock needs to base. It needs to pull back into the moving average again, which again happens right here. We see it tightening in range. It respects the moving average. And then this is really the buy point we're focusing on today, the early buy point or base breakout before it gets through the base pivot. And this one occurs right near that base pivot level. Enter here. You've got a nice cushion into the base pivot, and it just takes off. And the best stocks and best base breakouts look exactly like this, where they just go and don't look back. They have follow through not only the next day, but the day after that. And quickly you're up 10, 15, 20% in a matter of days. That's really a sign that you've got a big winner. So again, our playbook is after a stock breaks through the moving averages, look for the extension down, then the start of higher lows. And then at that point, you're looking for ranges or other areas you can, other ways you can work yourself in, like reclaims and moving averages or tight ranges that form against the moving averages. So that in general is applying this playbook right here. And I really encourage you, and this is kind of my homework for you guys attending this webinar, go back and study a lot of bases and look for those characteristics: the extension down or gradual bottoming action, the start of higher lows, the power off lows, reclaims and moving averages, and you'll see this playbook play off, exhibit itself over and over again. And you'll be amazed about, once you start looking for these extension downs, once you look for that first higher low, you'll be amazed about how you can find your ways in after you notice those subtle signs of accumulation up the right-hand side of a base. And I see a comment from Jazz. Extension down looks like an oops reversal. It can be. I mean, what is an oops reversal? Oops reversal is basically weakness that gets bought up quickly. And the best extension downs do look like oops reversals because it's the same concept. This one actually doesn't trigger quite away. It doesn't quite close above this low, but it basically is the same idea, the same general idea. You're looking for significant weakness, significant extension that institutions stepped in and say, hey, these are the best prices. We have to start accumulating now. They start their buy programs, and that's what causes the start of the move up the right-hand side of the base. Exactly. And yeah, this is very similar to the current market action because these cycles play out in stocks and they play out in the market as well. And this is back from last fall, but you'll see the same thing if you analyze recent base bottoms in the top leading stocks. All right, let me get a sip of water here. And then this is really key, guys. This is definitely one of the key concepts I want to relate to you guys today, is being able to spot and just the general importance of tight areas, tight ranges. Constructed bases will exhibit tight areas throughout the base formation. It might occur before the extension down, it might occur shortly after or up the right-hand side, but we're always looking for these tight areas on a decline in volume, lower than average or lower than most of the days in the past. Basically, what this is a sign of subtle accumulation. It's institutions stepping in and accumulating any supply, and just subtly accumulating stock and absorbing that supply as the base is formed. These tight areas, typically they're about 3 to 4 days, but they can be as short as 2 days, even 1 day if we're really mature up the right-hand side. And basically what you're looking for to identify these tight areas, and we'll show a lot of examples and I'll walk you through it, is we're looking for highs and closes to line up to form a pivot. And what that does is it creates that clear line of short-term resistance that when we break through that, we're expecting expansion. We're expecting a burst in momentum. And just again, over the course of the base, you'll start to see more and more of these tight areas form as we decline in volatility from left to right within the base. Then again, just getting a little bit more into identifying pivot points, which is basically the top of those tight ranges. A pivot point is a clear short-term line of resistance that when a stock breaks through, the expectation is a burst of momentum higher, ideally triggering additional pivots like the base pivot or a higher time frame range pivot. And basically, again, we're looking for ranges and confluences of highs / tight closes. That's what creates these pivots and creates the momentum. That compression is what leads to contraction. And as we go through a few examples, I want you to keep these kind of 4 general is what I call priming patterns in mind. So I presented these 3 in the general webinar. This is kind of a bonus one just for you guys, but these are kind of the ones that I look for within the context of an overall mature chart pattern and ideally within a tight range itself. So here we've got an inside bar. This by itself signifies contraction. We're looking for a break through this high and this high as well. A break through this high should lead to a break through this high and again trigger multiple pivots at once. A flip side to that is an upside reversal, and this actually is a subset of it as well. It's also an oops reversal, a big short-term momentum shift where we move down, but then we're bought up and rallied back into the body, and then we're looking for follow through and break through this high, and then a break through that high, and a break through the range at large. Then we have a variation, a positive expectation breaker, where we expect the stock to fall through lower because of this negative close, but instead we gap up and hold and form a pivot right near these 2 highs. Then this bonus one is what I call a tight setup day. So we have maybe a range of a few days here, and then we get one day which tries to break out of that range, or maybe it doesn't quite, but just forms a really tight day relative to recent price action. You can see that this body, this candle, this bar, whatever you want to call it, is much tighter than normal. And the close is near the open. And overall, there's just a contraction of volatility. Likely this occurs on low volume as well. And what we're looking for after a bar like this is expansion higher and re-breakout through this pivot. So often this happens with squats. The stock just wasn't quite ready yet. It had to ring out the last week holders. But, this is something not to be ignored when you see this. This looks like a failed breakout, but really what it is basically further contraction in volatility. If you look at this on an intraday chart on a 65-minute time frame, you'll probably see a tight range after an initial attempted move higher, and then it forms a range at the end of the day, and then likely the next day or the day after that is when we get that expansion expansion up and break out through that range. So in terms of short-term patterns, these are some that you want to keep in mind. Not because you want to memorize what these look like, but you want to understand what they signify. What they represent. Basically, you want to look for short-term momentum changes, and these are ways that a stock can reverse from being in a short-term downtrend or sideways range to starting an uptrend with enough explosive power to complete the setup. All right. So let's get into an example. This is Shop back in 2018, I believe. Let me go ahead and zoom in here. And again, we can see it was in an uptrend. This is a move off the IPO lows here. Then we break below the moving averages. What's our playbook? We're looking for tightness or bottoming action. We get that tightness. You can see all these closes are pretty much grouped together. We see a bar where it tried to break lower and then was bought up. So this is the start of a potential base. We see some higher lows form. It reclaims the moving averages. This is a little bit early given this sharp break for you to be looking for entries, but you're starting to look and try to wait, and you definitely be having it on your watch list here. And ultimately, Shop chops around, it breaks below the moving averages, reclaims it, tries to rally, and this would be a proper buy point here, but it fails, so you'd be stopped the next day. But then what happens again, this is likely due to some market volatility as well. We form another expansion down, and then that gets bought up, and we reclaim the moving averages. And again, at this point, what are we looking for? We're looking for a tight range above the moving averages, and we get that exactly right here. And we see a tight range. This is about 4 to 5% from high to low, this entire range. And we've got a clear line of resistance. And then what do we get? We get a little bit of a positive expectation breaker, and then follow through and the consolidation pivot breakout right here. And this would be your proper entry. Managing risk on that day at the low of the day. It either works or it doesn't. Again, this is below the base pivot, so you've got a nice cushion going into this volatility. You can see how it stalls at this area, but it does respect the 21 EMA area. And then from that point on, I think Shop doubled and tripled, and you got on at a really nice low risk entry right here. Even if you put your stop the low the previous day, if you're a little bit more in favor of a slightly bigger stop, I think that's only about 2-3% even at the low the previous day. But you're along for the ride and didn't experience any heat, didn't really test your cost at any point during this example. So again, we're looking for expansion up, then tightening and a higher low and entering before the proper base pivot. Here's another example for spotting pivot points. We'll kind of walk through these two different bases from Nvidia back in the, I think, 2019 timeframe. So let's go ahead and zoom in here. All right, so we get a break below the moving averages. We're looking for an expansion down. We get a very negative bar that breaks below the 200-day moving average. Everybody is going short. Everybody's very negative here. But instead of following through to the downside, Nvidia pops higher, retests the moving averages, and starts to tighten here. And then look at this bar. This is a subtle tight area. And you can see that the closes are close together for these last three bars. These two highs are close together. This is, in general, is a very tight day. And you can see the decline in volatility from left to right here. And this is your first potential buy point. We pop higher here. We set up another tight range, subtle tight range, and these highs line up, and we get a break higher, and then sets up one more entry, very tight range here, which reconfirms higher. So you've got 1, 2, 3 shots at this before the base breakout. And good you did, because again, at the base breakout, this ultimately fails. So even if you did enter here, you've got a positive trade, or at the very least a break-even trade. It does ultimately break below the moving averages again and start another base. And we get some choppiness, but overall tightness here where there's no follow through lower. There's no break below the 200-day moving average. We have an oops reversal here. And then this is where the subtleties come out. Because again, you want to be looking for general ranges. And even though this is up and down and there's gaps up and down, this overall is forming a range and short-term box in this area. Let me know if you guys can see that here. And to my eye, the resistance level lines up with these highs, these closes, and that's why you draw here and we get a gap and go, and this moves higher. But even if you didn't see this, or even if you saw this after the fact, maybe on this day after it broke out, seeing this tightness after the fact and subtle accumulation is a suggestion that you want to keep focusing on the stock and look for the next buy point. And after we reclaim the 21 EMA, this is a much cleaner, much tighter range. So even if you miss this one, no big deal. Again, the idea is not to get in at the lowest price, but the lowest risk price. And you can actually manage risk a lot tighter here because the tightness of the range is a lot tighter than this range. So again, all these highs line up. This is where you draw your pivot point. This bar looks to be breaking the low of the range. We get a slight positive expectation breaking the next day. Clear push through that pivot. This is your entry point, managing risk at the low of the day, or this low right here. And you're off to the races and in a really nice trade of Nvidia. So again, that's kind of the playbook as an example in a few different names as well. Let me get a sip of water here. All right. So this is a faster stock. This is RKLB last year, but the same concepts apply. And I've actually found that these momentum movers like RKLB, some of the a little bit more liquid names that are making these huge moves actually set up almost better pivots and tight areas, but they're often a little bit shorter. They're 1 day of tightness, they're 2 days of tightness instead of a 4 days of tightness or 5 days of tightness. So again, you just want to shorten up your mindset a little bit with these faster mover names, both in terms of your buy rules, sell rules, but also the bases will be tighter, the bases will be shorter. So that's one thing to keep in mind with these faster, higher ADR names. So let's go ahead and walk through here, and hopefully you guys are enjoying these walkthroughs of charts. We get a break below the moving average. This is overall within a base, by the way. So this is just kind of the last bit of the base where we get another expansion down. We pop back through the moving average. And then what do? Look how it tightens up on these days where, again, it wasn't able to push lower below the 21 EMA. We get a tight consolidation day. This is kind of an example of the last priming setup that I talked about where, yes, we tried to break through this high and failed, but overall it didn't really penetrate too much of this bar right here and just pretty much held. And that type of day can set up a nice expansion day the next bar, and that's exactly what happened. We get expansion higher, we move up. Let me zoom out a little bit. That's a little bit close. We form another short base here, and again we get an expansion down, but there's no fall through lower. That's another kind of key golden nugget to look out for. Up at the right hand side of bases is when we get an expansion down, that there's no fall through lower and it immediately gets bought up. That's telling you that the stock is getting ready to make a move. And we have a positive expectation breaker here. We have a nice inside day with a great close. And this high is lining up. This high is lining up with this high. You can draw the pivot in right here. And we get expansion higher from that point. So this would be your buy point right here the next day. Managing risk at the low of the day, very minimal risk. Even managing risk at the prior day's low, very minimal risk. And you're on for the ride and riding it here. Here it moves up, forms another range. This would have been a buy point as well, but really it doesn't progress from this range, this general range, but it sets up again nicely here. Look at this very tight day, setup day right here. We get another setup day because we get an upside reversal. So here we get 2 setup days in a row. These highs line up. These highs line up with these ranges. And it's when you get these confluences of pivots where things really can get explosive. And that's exactly what happens here with RKLB. A breakthrough this high right here, strong move higher, and I think it was up 20-30% in these 3 bars here. It goes into another short consolidation. Again, with these high momentum names, the bases are going to be a little bit tighter, maybe 10 days, 15 days versus, a few weeks. And look at this tight inside day here where you get an entry through this high, and that starts this next momentum move higher. So again, upside reversal, tight inside day, break through this high. This is your entry point for a swing trade, expansion higher, and we get one more general consolidation here. We get a retest of the moving average. It gets bought up, continuation higher. Then it pauses below these pivots, sets up an inside day, and then this is your pivot point through this high and breaks higher. So hopefully that was helpful for you guys. You might have to rewatch the replay and go through, and basically, you know, the best thing to do would actually be to study this move yourself and do it by yourself, first of all, and try to identify buy points, all of that through tight areas, tight ranges, and then kind of follow along with me as I did it again. But, you know, these are kind of advanced entries because it takes a little bit of practice experience to identify them. But that's kind of one reason why I created the RMV indicator to help spot these tight areas where you're seeing contraction that might not be obvious to everybody, but this indicator will kind of spot it for you. So this is RMV. If you're not familiar, I've done entire webinars on this. This is a proprietary indicator to Deep View. And basically what it's looking for is a contraction in range, exactly what we're looking for, a tight area. And it will go close to zero when we're seeing a relatively tight range form. So this first buy point that we talked about, RMV went to zero. This inside day right here, RMV went to zero. And this range here was overall tight. It went to zero again. And then once again, right at this upside reversal, it approached zero again. So you're looking for these sharp drops close to zero, and that signifies a tight range relative to what previously has happened. And then here again, this tight day right here went to zero. And you'll see this continuously as stocks fluctuate between expansion near 100 and contraction near zero. And I like using RMV5 for these faster movers, while with an Nvidia or a Tesla, a little bit more of a mature company, slightly lower ADR, I like to use the 15-day look-back period. But I'll maybe email out the entire webinar on RMV because there's too much to cover just in this webinar. But basically, this is a tool that can help you spot these tight areas and actually screen for them in Deep View. So that actually saves me a lot of time, is instead of having to go through a bunch of charts and look for the tight areas, I can screen for stocks that are showing RMV less than 10 or less than 5, and then that's a much smaller subset to go through each day to look for these potential entries for swing trades or position trades the next day. So that's one tool that can help you spot and trade base breakouts and VCPs. All right, so that's identifying ranges and finding the pivot points. How do you actually trade them when after you've identified them? Well, there's kind of four main ways, and you've probably heard me present this before, but it's worth going over because some are going to appeal to some of you who like to trade more pullback style. Some prefer buys into strength and are going to appeal more the standard way. But to each their own, and you can mix and match and build a position using multiple techniques. So we'll go into each of these, but in general, the four different ways are accumulating versus the lows of a range. So you can picture this being, a 2-day range or 3-day or 4-day range. All the lows kind of line up together here and you accumulate versus those ranges. And for each of these, again, just think about it being maybe a 2 to 3 to 4-day range. So here is the first way. So again, you've got maybe an expansion off the base lows. We have a pullback and tightening and range here. And the entry for this one is basically versus the low of that range after it's been established. So you enter here as it starts moving up off that low. Your stop is just below the low of the range. It pulls back again. Your stop is just below the range as it reconfirms higher. And this will get you the best price, but you might be more susceptible to getting shaken out of the stock because your stop is just below the low of the range, which might be shaken out, and then it reconfirms and goes higher. But there's actually another entry tactic that shows how to do that. Here is the second way to trade a range. You've got the anticipation setup. Again, accumulate versus the lows is back here. This is after it's moved higher here and is approaching the top of the range. You enter on kind of a higher low up the right-hand side of the range. Set your stop at that higher low and enter anticipating a breakout through these highs. Maybe this is the high of the previous day and you're anticipating a breakout through that. Then we've got the next one. This is probably my favorite. And this occurs quite a bit when the stock and actually the market, and this is kind of a golden nugget here, guys, so pay attention. This occurs a lot when the stock and the market as a whole, there's a lot of stocks showing tight ranges. Everybody's expecting expansion higher, and we get maybe a gap down because of news or a shake lower in the morning because of news. And we undercut the ranges of all those stocks, but then institutions step in and are using that weakness to buy positions, and we quickly kind of reclaim this. All shorts, everybody who shorted the stock as it broke lower have to buy it back and cover their entries, and anybody who got shaken out that was long has to buy back their entries, and that creates momentum. And the initial entry here that gets you at a profit immediately, and then leads to the ultimate breakout through the highs of that range. So you can first enter as it reclaims the range, and then add on as it actually breaks out of the range as a whole. This is the last one. This is just the standard range breakout. You're entering as it breaks through the line of short-term resistance, maybe the highs of the day prior, the two previous days, setting your stop at the higher low, and maybe adding a little bit on the next intraday higher low as it goes. So those are kind of the four main ways to trade ranges. So again, when you identify a tight range, whether with RV or just by spotting it on the charts, look for and consider four different ways to trade that range, and some are going to appeal to you. I think this one is a fantastic one to learn if you haven't already. Look for those shakes below and reclaims, because you can manage risk really tightly versus the low of the day on an oops reversal or upside reversal here, and it often gets you a really good price to participate in that range breakout. But let's get into trade execution in just a second, and let me pause here and answer any questions. I'll be sending out the link to the recording, guys, unlisted on YouTube, only for you guys, so please don't share it with anybody else. This is exclusive to people who have purchased the Trader's Handbook, but I'll be sending that to you guys likely by tomorrow. Let's see here. All right, there's a lot of questions. Fred asks, what is higher ADR in percentage? I would say anything above, 5% ADR is getting up there and more of a performance enhancer swing trade type name than a position trade type name. But Nvidia can move with 4% ADR and do really well too. So 5-6% plus, definitely 8%, 7%. That's getting pretty high ADR. And I like RMV5 with those type of names. What is the main moving average you look for base consolidation? I like using the 21 EMA. That's my main one. And that lines up really closely with Oliver's 20 EMA. They're basically the same exact moving average. So the 21 EMA is kind of my absolute favorite to identify those bases, and the general pattern of break below the moving average, expansion down, reclaiming the moving average, and then higher highs and higher lows of the right-hand side. Rick asks, how do we factor in volume with these setups? Again, you're looking for, with that range, a decline in volume, suggesting that there's no more supply coming to market. So we're looking for a decline in volume along with the tight range. And let's actually go back to RKLB. And right here, this is probably the best example. You've got the tight range here, very tight inside day. Look how tiny volume is compared to when the stock was moving higher. And throughout this base, as it's tightening in general, you're seeing a decline in volume. This is exactly what you want to see. Tightness during the consolidation, setting up the next move higher, pick up in volume here as we expand higher, tightening again, and lower volume as we contract, and then contraction again, lower than this volume here, and then expansion higher on higher volume. So again, on expansion, we want to see a pickup in volume. On contraction, we want to see a decline in volume. That's constructive price and volume characteristics. All right. Trade execution. You've identified a pivot. You've identified, which of these four ways you're going to trade the stock. How do you actually go ahead and execute? Well, this is an example using the standard range breakout method. Basically, what you want to do is when you've identified this pivot, maybe the day before, maybe you can see these ranges, and that would be your pivot right here. You want to set an alert slightly below that range pivot. I like to do about 0.5% before. And the reason being is that this gives you time to set up an order in your broker if you haven't already. And these moves can happen very fast. The early alert and standard alert will trigger almost at the same time sometimes, especially in the strongest moves. So you want to give yourself time to be ready, to be able to place the order with your broker and be ready for when it actually breaks through the early alert. So basically, you want to place an early alert the day before or even the day of, and then as the stock breaks through that alert, you want to prep your order, think about where you're going to place your stop, verify that this percentage distance from your potential entry to the low of the day is within your risk parameters, and then simply you place your order as the stock breaks through the line of resistance, and hopefully you're off to the races and have a good cushion by the end of the day. That's the ideal method. So again, this is just a quick summary over on the left hand side. Basically, what I just said: set early alerts, and then prep your order as the stock approaches your actual pivot point. All right, here's a quick bonus for you guys because this happens often enough that's worth talking about. What happens if there's a perfect range, you're ready to trade it, but instead of consolidating and then breaking out all in one day, we get a gap up? What happens? Do you chase it? Do you just try to enter and hope? Well, hope is not a plan. So let's talk about how to actually do this. So this often occurs when everything again is coiled and we get a gap up in the market and you see the best stocks just gap up away from where you want to enter. It's very frustrating. But I think the key thing to remember is you don't want to chase. The best stocks, the CrowdStrikes, the PLTRs, the Nvidias of the day, they're going to set up multiple times and multiple chances to enter. We showed the Nvidia chart. There were multiple tight ranges up the right-hand side where you could manage risk and join for the real move, which happens after the standard base breakout. So everything within the base is early. You want to really internalize that. So don't feel like you're missing the one shot at getting into a market leader if a stock gaps through a range, because often enough it will tighten again, it will pull back to a moving average, and even give you a better shot at entering the stock. But if you do want to enter the gap up day, I think this is best early in an uptrend when everybody's doubting gaps. What you want to do is wait for some type of range. And I talked about the opening range breakout setup in the Entry Tactics webinar, so definitely go ahead and rewatch that. But often after this gap, you'll see a pullback into the prior day's close or the high of the range. And then you're looking for a reconfirmation up and the start of basically a move up the right-hand side of that intraday base, intraday range. And then you can enter and manage your risk at the low of the day, just below the low of the day. So this allows you to position while keeping your risk very tight. And sometimes they'll gap and go, but that's just trading. Sometimes you're going to miss, an entry point, and that just happens. But trust me, you're still early if you're within the base, and there's going to be another pullback to the 10 EMA, another range that forms. So don't feel like you missed it, even if it gaps and goes without you. That's just additional evidence to focus on that stock and look for another entry tactic. But this is a way that you can trade a gap above the range, is wait for a pullback in and maybe wait for the daily anchor VWAP reclaim and then enter and measure risk at the lows. I've used this quite a bit. I use this for PLTR recently on the gap, and it allows you to position while keeping your risk in check. So here's actually PLTR. We had a nice range that forms. I bought versus the 21 EMA back in the low of the range, but I did want to add on the actual range breakout. It gapped up here, pulled back into the range high, and you'll see this quite a bit the more you look for it. And you can enter as it reconfirms up off that level, and then it rallied 30% before running into earnings. But again, this is an early entry because we're well below the base pivot, and this allows you to manage risk by waiting for that pullback into the level and then reconfirmation up, and ideally it closes well and you've got enough cushion to hold through. Again, sometimes these are just going to break out and go without you. That's trading. But the key thing is you never want to chase a stock without and disregard risk management. You need to manage risk. That's the most important thing. It doesn't matter if you miss a stock. All it matters is that you can manage risk when you do decide to enter and execute a trade. So here is the intraday chart here. This is the pull-in and then the reclaim of the anchored VWAP. That would be your entry, managing risk at the low of the day. So that's how you can manage risk on an example with PLTR right here. All right. So let's get into routines, and I might show actually kind of this process live and deep for you in just a minute if you guys want. But routines and processes for finding base breakouts. The key thing is that you should keep it simple. Review a general screen or your universe list if you prefer working that way, and basically look for high potential stocks that are moving up the right-hand sides. They've reclaimed the moving averages. They've started to form higher lows, and basically look for ones that are tightening under short-term resistance level. Then the best ones that look the most ready, maybe they've got a priming setup, priming pattern, put those on your daily focus list and prioritize stocks that are in ranges, ideally with an inside day, an upside reversal, an oops reversal the day before. Those are the ones that are primed for short-term momentum burst, breaking through the pivot and ready to go. And then, like I mentioned, set alerts below the pivot point. So this is a very simple but effective routine and process for identifying, base breakouts, potential base breakouts. All right. Yeah, when to trade base breakouts. Base breakouts work best in strong market environments or the beginning of new uptrends. They don't work during corrections. During corrections, these pivots that work really well and give you great risk opportunities, risk reward opportunities during uptrends will be sold into, and you'll see downside reversals and failures. We want to avoid these type of setups and entry tactics during corrections and when the market is generally below its 21 EMA. So don't force pivot buys in bad markets. This is key. This will prevent you from getting chopped up in a 2022 or even 2021 where things weren't really following through. So really focus on trading base breakouts in strong market environments when everything is working, when breadth is expanding, when the market has just reclaimed the 21 EMA. That's when this works well and will be most effective. So this is really key, guys, is don't use this during bear markets. Don't use this during market corrections. You want to wait for that extension down, the reclaim of the moving averages, the higher lows to set in, and that's when you're looking for entries, when the market does that and when stocks are doing that as well. All right, so let's run through some key reminders, and then I'll run through my routine to find these in deep view live for you guys. So key reminders, base breakouts are one of the most powerful and repeatable setups. We're looking for early entries before the stock is extended in the eyes of the market at that base pivot. We want to develop a base trading playbook with entry tactics. That's what we talked about. And then look for clear pivots and priming patterns like inside days, upside reversals, expectation breakers, setup days, tight setup days, all of that. And then this is key. Again, we're not looking to trade every stock that sets up in a base. We're looking for tiger stocks, high potential names, high momentum names, whatever you prefer to trade. Make sure you're prioritizing the best of the best. Then again, this is key, and we showed the entry tactics that allow you to do this. You want to manage risk tightly and logically. That's really, really important. You could probably have a random stock and a random overall setup, but if you manage risk tightly and logically, you'll protect yourself and manage risk. That's the most important thing. So we definitely want to echo and emphasize that. All right, so let's get into some sneak previews of the base breakouts model book and walk through some more examples here. Let me get a sip of water here. All right, so here is an example of an IPO base here on the left-hand side. We see contraction and volatility from left to right. And then again, we get that priming pattern, that inside day before the actual range breakout. It triggered this early buy point, broke out, and then the best stock set up multiple ranges. This was an aggressive range breakout again, and then it just gets too extended to deal with. But then we form another base, contracts from left to right. There's some potential buy points in here, but it's a little bit early. But we're overall forming a base and constructed pattern. We set up another nice pivot right here. And through that high, you get some expansion up. I think this is up like 50% in 3 days. But really, the best one to study is back here from the IPO base. And I say here, inside days and upside reversals also offer a clear short-term pivot through their highs, looking for fall through, and a clear line in the sand at their lows for a stop loss. So again, we can manage risk tightly, and we've got a clear buy point. So again, here's my key tip. Watch for inside days and upside reversals near pivots once a base matures. They can prime a base, letting you know to put it on your focus list and watch it carefully for a breakout. And again, look at the price and volume characteristics. Look at the low volume here. Then as we start to lift off the bottom of the base, we see a pickup in volume, and then very low volume right before the actual base breakout. So this is a really good example to study when you're talking about IPO bases. Here's Uber back in 2023. This is a longer term base. We've got a strong prior trend. We've got a break below the moving averages. It tries to move up higher. Again, if you're waiting for the base breakout or enter here anticipating the base breakout, you get stopped out, and it ultimately shakes lower again and basically forms another short-term cycle where eventually we reclaim it, start to move up, and then you've got not many buy points in terms of ranges here, but here at the base pivot, you've got a tight range here that ultimately works. But this is a good example of how to trade a base and how to think about this type of base where you get a double bottom type move, which we've had a lot of these recently. And there's another good example of looking for extensions down that don't follow through, and that often marks the start of a new base and a move up towards those base highs. Here is GEV, which looks pretty similar to App last year. Again, we have a nice base, a few months long. We get an extension down that gets bought up. We get the moving average reclaim. We get tightness right near the base that then shakes out and then forms, this is actually, let me actually zoom in here. We get a nice inside day setup day. We get the pivot breakout, manage risk at the low of the day. It actually sets up another inside day and another breakout move. So you could have entered this day or this day here, and this gets you along for the ride. And this went up, over 100% in short order. But those are a really good example of a nice priming day with those inside days. All right. Let me go ahead. It's lagging a little bit, the screen share here. Let me actually stop share and reshare, guys. All right. Let me know when that pops up. All right, there we go. Cool. Yeah, the PLT chart is in the model book. Awesome. Here's AMD, and I want to include this because this is more of an example of the gradual bottoming base versus the sharp expansion down, but these can work really, really nicely as well. This is more gradual. There's some tightness throughout the base. Right here is a tight range, and then we start to move up. We pop through the 21 EMA, and then this is really the best range to trade right here. And what do we have before we see the expansion up? Look at this tight inside day right here. Let me zoom in to show you guys. This happens almost every time before a range breakout is we get a tight inside day, a priming setup, and then we get a nice breakout move through this high, as well as these highs right here, as well as this kind of overall flag. And then we get another setup day right here, potential add point, because again, this is still early up the right-hand side. And we just see expansion, contraction, expansion, pullback, expansion. Then we get an oops reversal entry. Again, we shook out at the base pivot when it's in the eye of the market. And then there's the next low versus buy point here with an oops reversal. All right, here's TTD, another example of expansion down that then sets up higher low. This is a very early, potential early entry, but really I think what you want to focus on is these ranges that form here, and then the ranges that form here as well. And you get a nice setup day here before this base breakout. This is really what I want you to focus here on. And let's zoom in. That's a little bit much here. Zoom out a little bit. There we go. That's better. So this mini base here up the right-hand side, it's really a handle of the larger base. What do we have before the nice entry? We have a setup day. Very tight range relative to recent price action, and it occurs right below this line of resistance. This is your buy point, managing risk at the low of the day. And the next day you get the reconfirmation and the breakout. So you're entering early. You've got a cushion going into this. You could even add here if you'd like to, but you're entering early based on the early entry tactics we've talked about in today's webinar. All right. And that's, I think, the last example here. So let me actually go through, go to Deep View here, and I'll show you kind of my process for scanning for these breakouts. So let's go ahead and escape. And give me 1 second, I'll share this, and we'll pause for some questions before I run through my process in Deep View. All right. So here we go. Let me share this. All right, cool. Okay, so let's see some questions here. For early entry, should the slope of key moving averages be considered? If the stock is not ready to pop out, it can be identified by declining MA. Yeah, if the 21 EMA is still declining, I'd say the stock likely needs a little bit more time. Here, you wouldn't really want to buy a pop through the 21 EMA here because declining 21 EMA, declining 50, all of that. We're looking more for stocks that have a flat 50 SMA or a flat 21 EMA and are mature enough, there's enough of a right side built for they can pop up and start their move up the right hand side. And that's a little bit of more of an art, is recognize when a stock is ready. But even in here, this is just a random example of an intraday chart. You've got a more gradual base here building, and then you've got a powerful pop here versus this is a more of a sharp decline. Now let's go back to a daily chart here. There we go. All right. Let's answer some question. So daily time frame is a really good question from Sashil. Um, I only ever look at intraday time frames if the stock is set up on a daily time frame. It's in a range. It's got a setup day with the inside day, and then you can manage some risk on intraday charts. But I think it's really important for newer traders is to really focus on the weekly chart and daily chart, and don't get lost in the intraday time frames, because you can always find a reason to buy on an intraday time frame, but you want to make sure that the stock is set up and you can manage risk on a daily chart. That's really, really key. All right, let's answer some questions here. There's a lot, guys, so I don't think I'll be able to get through everything, but let's see. The tightness indicator is called RMV. Let's see here. DeFi Leadership is a screen that I designed. It's basically looking for high momentum names. This is a criteria here, or strong earnings and sales growth, or a recent IPO, basically. So it's looking for stocks that meet the characteristics that we look for in order to determine leadership here. And it's a pre-built screen here in DeFi that's available to everybody. Let's see. Yeah, RGC is actually a good example of tightening recently. This is a powerful move. And let me actually add the RMV here. Well, actually, I'll just switch to this layout. So basically, this is a really highly volatile name, but it's a good example of what you want to see in terms of tightness and price and volume action. Pickup in volume moves up and all that. Look at this tightness in the base. RMV went to 0 and it moved up a little bit because it just got so tight for so long that anything looked tight. But let's actually change this to 5. So this is when it got tightest right here. And then you see tightness again here as it broke out. But overall, really good example of expansion move up, price action, tightening, clear pivot right here. Buy point is here, or also here. I think through this high is also another buy point, and expansion higher. All right. Let's see here. But that's a super fast mover. That's kind of an outlier in terms of most people wouldn't want to trade that type of name. They're very volatile. Let's see here. Yeah, all the prior webinars, all the standard webinars will also be included in the Trader's Handbook educational resource. So all of those will be available to you guys very easily. When trading a breakout above a pivot level, how do you decide whether to exit early if the price pulls back toward your entry versus giving this trade more time to play out? What's the thought process behind managing that kind of price action? So on the day of the breakout, I want to have at least a 2% or to 3% cushion at the end of the day in order to hold through. If the stock pulls back into my entry, towards the end of the day and doesn't have that cushion, I'm going to take it off and maybe try it the next day if it sets up again. But if it pulls back in and doesn't give me enough cushion, I'm going to scratch that trade and look to fight another day. The next day, if it pulls back in, I'm going to give it towards to my original stop because I've accepted that loss. But, if it's breaking below my stop, I'm out. I'm stopped out. I'm stopped out with my broker. So that hopefully answers it. But I'm not trying to micromanage things. But if a stock is going to stop me out, it's going to stop me out, and maybe I'll retry it. But I don't want to fight the price action. I want to listen to that and deal with it as it comes. Yeah, good question, Jazz. Batting average on these type of setups is 40 to 50% likely, maybe even 35 to 50%. It depends on the market environment. In a strong market environment, these are going to work really well, but there's always going to be stop outs, right? And maybe it shakes out and sets up again. But the best trader, 35 to 50% can be incredibly successful because this is an asymmetric trade. If it works, it just goes without, it goes and you're on for the ride. And you're managing risk within just a few percent. So just a 10% gain could be 3R with this type of setup. So you really want to think about risk versus reward versus the batting average in this case. All right. Some good questions there. Pradeep asks, how do I trade during market corrections? I don't really trade during market corrections. I'm waiting for the steps to occur. That's the short answer. Okay, cool. So let's dive into my process for actually screening for and finding base breakouts. So this is the DeFi leader screen. This is my go-to general screen. It's kind of the best there is. It's going to look for momentum. It's going to look for growth, all those characteristics we're looking for. And then to save time, we have RMV, which is, again, this indicator, this tightness indicator. We have it built in as a column as well. You can add it to your column set, and I click it twice to sort from lowest to highest. And then all these stocks that show up here have tight right sides. So I don't have to guess to see if they have tight right sides. Just all of these are tightening relative to recent price action. And I'm going to change this back to 15, which is kind of the standard that I use. And it's what the data column is. So all of these are tightening. So it showed tightness right here. RMV went to 0. Tightening over these 4 bars. Tightening going into 0 here. So all of these have tight right sides. But I'm looking for ones that are up the right-hand side or setting up clear buy point. TTWO is actually on my watch list for next week because you've got a tight range right here forming. Again, tightening here, but not really a clear pivot with these highs. So I just watch for another day. XPV, it's got this tight range, but it's a China stock. So I do have it marked up and alerted, but I'm not looking to trade that one. DRS, this is on my watch list. Again, forming this tightness, RMV going to 0. So you can see how RMV saves you time because by default, stocks with RMV equals 0 are already tightening for you. So all you have to do is look for these tight areas where you want it within the base or shortly after the base. And I'm looking for those tight areas up the right-hand side or maybe the first one after the base breakout. And those would be the ones I consider to actually trade. HSAI, it's kind of leaking below here, but it is tight over the past few ranges. Ego, not too interesting. This one, you've got kind of tightness, but it's a little stretched from the moving averages, so I'm not going to add this. So basically, I'm looking through and trying to find ones that I want and would trade. Uber, right on the base pivot, so this would be one I add to the watch list, especially because it's performed really well and is a leadership stock in my mind. AGI, tight range here, clear pivot point, I'd add that one. Oscar, recent gap, forming a tight range, but I'd like an inside day here. Pega, it's tight, but that's just because of the gap here. So I'm just kind of looking for these spots, and there's not always all these trades. This is Grail. This is on my watch list. Watching for a re-breakout through this level, so I'd add that one. So that's kind of my process, guys. You go through from tightest to least tight and look for clear pivot points. So here is a base right here. This is the pivot through the upside reversal day. So that would be your pivot for this name right here. And here's another last example. ZS, nice tight range here. Clear line of resistance through here. Upside reversal priming the setup, also actionable off the 10 EMA. So watching for reconfirmation through here early next week. And this is actually already on my watch list. So that's my process. And then I'd add all of those to a watch list, sort through, find the best of the best ones. And that would be my weekly focus list for the next day. All right. Perfect. I see a question. Did these patterns work on a weekly chart and 10-minute chart? It's fractal. The nature of the market is going from expansion to contraction. And actually, I think a good example, and let me X out of this here, is Nvidia. And let's go to a weekly time frame and go back to this base pivot right here. This is exactly what we're talking about. A tight range up the right-hand side of a base. This is actually a 3 weeks tight as well with tight closes. But if we actually add RMV here on a weekly chart, and on a weekly, I like to use 3 or 5. It's identifying this tightness right here. RMV is going to 0 right here to get it on your radar. So this is fractal. It works on all time frames because that's the nature of the market. It's a byproduct of supply and demand controlling prices to move from expansion to contraction. Yeah, good question. All right. So I think that's pretty much it for what I wanted to cover today, guys. I see some questions, but they're not all related to breakouts. So I want to really stay focused during this webinar. So hopefully you guys appreciate it. Give me some thumbs up in the chat and let me know how I did. If you guys enjoyed this, let me know. Hopefully you guys did, and I look forward to seeing you guys in the next bonus webinar, which will be on trading gappers, I believe, early next week. Yeah, thank you guys so much. And once again, thank you guys all for purchasing the Trader's Handbook. Definitely appreciate that. You guys are going to love it. Really excited to get into your guys' hands. And if there's a trader friend or someone you know that might be interested, let them know about that resource as well. Again, I've talked about this many times before. It's more than a book that you're getting. You're getting these bonus webinars. You're getting all the webinars that we did presenting, basically how to build a trading system, going from entry tactics to risk management to position management. We're trying to create the best resource, introductory resource, and even advanced resource for traders to speed up their learning curves. And, hopefully you guys will really dig it. So thank you guys again. And I'll see you guys for future videos. Take care. Cheers, guys. Thanks for all the kind words. Yeah, the Trader's Handbook makes great gifts. So thank you, Alberto, who's purchasing some copies for his nephews. Excellent. All right, thanks, everybody. Cheers.